More doors, more real estate doors is not necessarily more profitable. More real estate doors does not necessarily equate to more wealth and more cash flow. Having been in the real estate investment space and financing income properties for over 10 years now, I've seen thousands of real estate portfolios across Canada. I've seen everything, from small portfolios to sophisticated portfolios, from, starter investors to empire builders, all sorts of strategies, all types of money. And here is my observation and some lessons that I've personally taken away as well, being behind the scene and seeing beneath the surface, seeing beneath social media, paying attention to those who are wealthy and truly wealthy versus those who appear wealthy but may not necessarily be wealthy. Here's what I can tell you. There is this obsession about owning as many doors as possible, owning as many properties as possible, becoming the Grant Cardone of the world. And absolutely, I am a big supporter of growth. I am a big supporter of aiming higher and aiming for more. That's how we grow as human beings. And why not if that's what you want to do? But here's the thing. I've seen portfolios with hundreds of doors, and I ask some of these clients, what's your cash flow every month? What's your takeaway every month? Because I'm curious, right? And I've seen portfolios that are hundreds of doors where the client is really trapped, managing this large portfolio, burnt out. They're behind on their accounting. They're behind on, paying bills. They're behind on multiple things related to the operation because they're being busy chasing the number of doors, but not really paying attention to the foundation on which these doors are built. And therefore, their net result is not very good. And I've seen other investors who have smaller portfolios, very manageable. And by small, I'm not talking about one door. I'm talking about maybe a portfolio of 10 to 15 properties versus a portfolio of, a lot more than that, or hundreds of doors. And I've seen these smaller portfolios generate gold, generate cash flow every single month, and build wealth consistently for their owners. What is the point I'm trying to make here? What I'm trying to convey to you is that more doors is not necessarily better than less doors. It's really going to boil down to how you structure the debt on your portfolio, buying properties that at the end of the day will yield you cash flow, buying properties that are in markets that will appreciate for you over time so you continue to build wealth. And here is an idea that is a little bit different. When you buy a rental property, at the beginning, half of the payment, the mortgage payment, goes towards interest, and half of that mortgage payment goes towards principal. And we go and get a 30-year mortgage on the property. And your cash flow initially may not be that much depending on which strategy you've used. But if you fast forward and you have no mortgage on that asset, okay, and you've been managing that asset well, technically, your expenses on the asset should be in the range of 30 to 35%. And if, let's say, you're renting the property for $3,000, the difference should come into your pocket as cash flow after expenses. I'm talking about the future, fast forward when these debts are paid off. So here's what I do with clients. I recommend that when you get a mortgage on a property, you take a bi-weekly accelerated payment. And the monthly payment may not necessarily be different from the biweekly accelerated payment. You get a mortgage at 30 years, but you go biweekly accelerated. And what that does is it cuts off the effective amortization on that mortgage from 30 years to about 26 years. And you keep that loan on the property, but the long-term objective should be, what am I going to do as an investor, right, to eventually burn that mortgage in the next 10 years, okay? And I'm not suggesting that you just use the money to burn it off, but maybe you do a buy and hold and you do a flip. And from that flip, you take some money and buy a new property, and you take some of it and accelerate the payments further on an existing mortgage. So the idea is that you don't want to have these mortgages lingering on your portfolio for the next 30 years. I've seen the wealthy, and the wealthy go through an asset accumulation stage, but then they basically get to this point where the leverage on their portfolio is 50% loan to value, 60% loan to value. And because the leverage has shrunk, right, their cash flow is now very, very healthy, and they're living off that cash flow, and they've got nice cushion of equity in their properties to pass on to the next generation, or to even leverage temporarily if they want to jump on an opportunity. So in summary, more doors is not necessarily better cash flow, not necessarily better wealth. You got to manage the operational risk. And if you choose to go down that path, no problem, just manage your operational risk. But I can tell you that you can still achieve stellar results being very intentional about how you build your real estate portfolio and how you manage leverage, the extent of it, and the life of the mortgage on the property. And if eventually your target is to have some free and clear properties over the next 10 years, all of that income, rental income you're receiving, a big chunk of it is going to flow to you in cash flow. So you can optimize and go deep instead of going wide and just increasing complexity. Just a thought.